Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is our latest offering, What's Hot, a show that focuses on the biggest buzz on the D Street. On the show today, we are going to be focusing on where are brokerage houses betting big on three key sectors: telecom, pharma and cement. And why are they top on radar? We will also be focusing on what's ahead in the QSR space. QSR stands for Quick Service Restaurants, and that's where you and I are usually focused on our daily lives. We will try to find out economically and financially how are these companies doing, what really is the action there and what to expect. We will also be focusing on the Q3 earnings. From next week, we are going to be seeing full-blown action on the Q3 numbers from all the companies that are listed on the stock exchanges. That will help us understand from October to December, how have the companies really performed business-wise and financially, where are the profits going, which are the sectors and the themes that are performing. We will also be focusing on that as well. So let's kickstart by first welcoming our guest on board. We have Sunny Agarwal from SBI Securities joining in to share with us his views on all of these topics. Sunny, warm welcome. Good morning to you. Happy New Year. Give us a sense of how are you looking at this new year? It's already panned out with some more volatility coming in after the initial joy that we saw in the first two trading sessions of January. What's the sense that you have in this new year? How are you approaching the markets?
Good morning and thanks for having me on the show and wishing you and your team a happy new year. Obviously, I think calendar year 2026 seems to be a slightly better year as compared to 2025, backed by three important factors. One is obviously earning growth seems to be going back to double digits. So at least for next 8 to 10 quarters, it seems that the companies within the benchmark indices are likely to report on a cumulative basis double-digit earning growth, and that should give a lot of comfort to the institutional investor. On the other hand, post 15 months of consolidation, we have seen that Nifty 1 year forward price to earning multiple have corrected from highs of 23 to right now we are trading between 19 to 20 times 1 year forward price to earning multiple. And third, obviously the premium of India's valuation as compared to its benchmark MSCI emerging market, which is one of the benchmark for a global fund manager. It has shrunk from 80% back in the September 24 to, as we speak, it is hovering closer to 47%, and that is below the 10-year average of 55%. So again, from a global fund manager perspective, the valuations of Indian market as compared to the benchmark MSCI has corrected significantly. So I think all these three factors offers a lot of comfort. Obviously, there are some headwinds in a short term, the rising geopolitical tension which we are seeing as we speak, and obviously the delay in a trade deal between India and US. There are that are the few headwinds. But having said that, I think markets have many opportunity, bottoms up opportunity. So if as an investor or trader, if you have your watch list ready with an a list of 50-60 stock across the multiple sectors which are likely to do well, then I think you are fairly placed in terms of getting return in a calendar year 2026. And at the same time, one need to temper down the return expectation as there are still a lot of uncertainty. So I think 12 to 13% return on benchmark indices. And if you are smart enough and able to pick a decent mid to small size companies which are likely to outperform other peers, then on overall portfolio basis, 15-16% return are likely during the calendar year 2026.
Okay, fair point. Let's now focus on the big three sectors that we have brokerage houses covering on top of their radar today, and we'll try and understand for you viewers, how are you looking at the opportunities there? Sunny, we'll start off with the telecom sector. Jefferies has come out with its 2026 outlook on the telecom space. Why they are focused on telecom is because they believe one of the biggest triggers this year will be the Jio IPO that will be coming in, and that is likely to boost the tariff discipline that we are already seeing right now. They also believe tariff hikes are likely around June of 2026, that's mid-year. Also, they were looking at AGR relief that could re-rate some of the stocks like Indus Towers, for instance. They also believe overall on the sector, we are looking at a stable capex, the rising revenues that is likely to boost the earnings of these companies, the free cash flow as well. They're also looking at the top picks, and their top pick currently remains Bharti Airtel because the other companies are not listed. Jio is not listed yet, and the target price for Bharti Airtel is 2,760. They also have a positive call on Indus Towers with a buy rating and a target price of 510. So let's focus first on the telecom space and try and understand how should one be really viewing this. In the run up to 2026, we did hear that the courts were also taking forward views on the AGR relief. We saw a lot of action on Vodafone Idea as well. Right now, the stock is hovering around 11.5 odd levels. But let's look at the overall telecom sector, how the picture is evolving, and what should investors do.
Yeah, even we continue to remain constructive on telecom as a sector as it has become one of a key necessity rather than a discretionary spend. So I believe the kind of penetration which we have seen in the telecom sector and post consolidation, now I think the existing players are well placed to deliver a healthy earning growth, backed by, as rightly pointed out, likely increase in ARPU, as India is one of the lowest ARPU market. One of the lowest cost market as far as telecom services is concerned. So I think annualized 5 to 6% increase in ARPU is not a big deal. It can be directly, indirectly, wherein we see some base packages getting discontinued, and then there is an indirect, there is a forced migration towards an higher value package for either prepaid or postpaid consumer. So I think the telecom as a sector is well placed in terms of growth outlook. And as you rightly pointed out, as of now, the only listed player is Bharti, and one more, there is a Bharti Hexacom which has got a presence in Rajasthan as well as Northeast Belt. So I think both the players are well placed to deliver a decent kind of earning growth. And Indus Tower, obviously, one of the key beneficiary in case the Vodafone gets an significant AGR relief. So Indus Tower is an indirect beneficiary of that.
Okay. So that's as far as the telecom space is concerned. Let's focus on the next big sector that is on our focus today, and that's the pharma sector. And Jefferies has again come out with a 2026 outlook on this one. They believe the H1 of calendar year 2026 might be weak for for some Revlimid exposed firms, but margin pressure from February due to competition could also be seen. Domestic pharma business, however, is seen stable in 2026. They also believe the Section 232 ruling is expected in the Q1 of calendar year 2026. They also believe export-oriented pharma definitely face some policy risk, remember, due to the tariffs and some other policy risks, although their topics are Mankind Pharma, Ajanta, Sun Pharma, Zydus Life Sciences. Also, they have upgraded Entero Healthcare to buy rating for now. Let's try and understand on the pharma space, largely out of too much of vicinity in 2025. What do you think is in the offing for the pharma sector? How should one be really looking at it? I think the only segment within the pharma and healthcare pack that performed well in 2025 was the hospital stocks. Do you think that will continue to perform even in 2026? Will it be the frontline pharma companies, the OEMs? How are you approaching this sector?
Yeah, coming to pharma, we believe that a few subsectors like CDMO, weight loss drug, which is a GLP-1, hospitals, which continue to deliver a very robust set of number, and biosimilars. So these are the few smaller pocket of the pharma which are likely to do well, in fact can outperform in terms of growth. So we believe within pharma, companies which are focused on CDMO space, case in point like Sai Life Sciences or Anthem Bioscience. So these two companies which we feel can deliver an healthy earning growth. Coming to weight loss drug, one source specialty. This company can do well. Again, Piramal Pharma, I forgot the name from CDMO space, is likely to do well going forward. Coming to hospital, obviously the frontline hospital like Narayana and Max Healthcare seems to be well placed to deliver an healthy earning growth. As you rightly pointed out, most likely the company which has got a significant exposure to an US market, they may face some policy risk. But having said that, I think ultimately pharma is a basic necessity. I don't think so any significant policy risk emanating from a developed world wherein they will themselves jeopardize the supply of key essentials like a pharma product. So I think from a frontline companies, maybe Lupin is the one stock where the biosimilar as a segment is likely to get a better earning growth forward. So Lupin is the one stock from a frontline pharma company which we are recommending to our clients.
Okay. Let's also now focus on the third sector that's on top of the brokerage house's radar, and that's the cement space, where CLSA has come out with its 2026 outlook on the cement sector now, viewers. Here, CLSA believes the profit pool is likely to grow 20% plus for the second consecutive year. The demand discovery and the recovery by housing and infrastructure may continue to boost the cement sector, provide a positive tailwind. The private capex revival is definitely key for growth going forward, and that's going to be a key watch. They also believe consolidation will be restoring the pricing power, and large players are likely to gain some more market share, they believe, in 2026. They also believe that top picks are UltraTech and Ambuja in that aspect. On the cement space, we've usually seen January to March being important as a quarter. A lot of construction activity really picks up, in January to March as well. How are you looking at this year as a whole by way of what could happen on the cement prices, what could happen on the consolidation front, on the infra boost? Because remember, 1st of February, when the budget also gets presented, a focus on infrastructure will also come in. We are again given to understand from a lot of our sources and reports that are indicating that the infra spend may continue to be elevated this time around as well. And what will that lead to in terms of participating in the cement growth story?
I think again a proxy play on infra and real estate sector. I think cement is well placed to deliver close to 6 to 7% kind of volume growth, which is in line with an GDP growth number, real GDP growth number. And as you rightly pointed out, calendar year 25 was slightly muted in terms of infrastructure spend as far as government of India is concerned. And again, we are hopeful that the ensuing budget will be focused on capex-driven growth strategy by the government. And again, that should be there should be a lot of support to an affordable housing segment, which is one of the key growth driver for the cement sector. So I think highways and real estate sector can be one of the key growth driver as we speak going forward. So I think cement sector is well placed to deliver a decent earning growth. But again, we would like to obviously large cap companies are likely to do well, but we believe even mid-sized companies like JK Lakshmi Cement, JK Cement, where we have seen a recent capacity expansion, so those companies are likely to outpace the larger peers in terms of earning growth. So if somebody has got a slightly higher risk appetite, they can look forward to companies like JK Lakshmi Cement or JK Cement also.
Okay. Let me also focus on the QSR space now, where Macquarie has come out with its report on the 2026 year and the outlook that they have on the quick service restaurant space. They believe the industry demand remains still subdued because delivery is still outperforming dine-in. And they believe that they have cut the EPS estimates by 7 to 23% on delayed recovery there. The demand recovery is expected in the second half of calendar year, they believe, and also their stock preference is Devyani, Sapphire, Westlife, and then Jubilant Foods there. Let's try and understand the QSR space as a whole. We've seen some consolidation take place in just the last couple of weeks. Devyani, Sapphire on that front. Westlife that operates McDonald's, Jubilant Foods that operates Domino's also came out with its business update for Q3 just a couple of days ago as well. And Devyani and Sapphire, as you all know, both are operators of KFC, Pizza Hut kind of chains as well. So the entire food QSR space is in focus right now. Let's try and understand what's in the offing. Of course, Macquarie is pointing out to a delayed recovery and delivery still outperforming dine-in because people are now used to delivering, getting their deliveries so soon and so often, that it has now become a part and parcel of everyday lives, and therefore going out has reduced because people don't want to encounter the traffic and the hassle. They want the comfort of their homes and yet the delicacies that they would have otherwise enjoyed in their favorite restaurants outside. How would you look at what's really shaping up this in the industry? How should one be approaching it?
I think last 2 years has been a pretty subdued in terms of demand environment for entire QSR space, and as you rightly pointed out, with an likes of Swiggy, Zomato, because of this food delivery app, the convenience has taken is one of a priority as far as consumer are concerned, and that has led to some increase in competition for the all entire QSR space. But having said that, I think Devyani Sapphire, the recent merger announcement, it will take 12 to 15 months for the synergy to play out. So I think till that time we believe the stock can move in, can be in a sideways consolidation mode. Among the QSR space, we feel that ultimately in a short to medium term, companies like Jubilant and Westlife are relatively well placed, where they have got a pan India presence. They continue to invest behind the brand and store network. And whenever there is a recovery in the demand environment, obviously these are the two players where which are likely to be the key beneficiary. So again, if somebody want to invest in a QSR space, maybe SIP is the right way, wherein one can accumulate the stocks of Jubilant and Westlife over the period of next 3 to 4 months, and be invested for 12 to 18 months to get a decent return in QSR segment.
And how would you look at the food delivery players then? Eternal, Swiggy, and in 2026, we're also looking at Zepto maybe making a debut as well. So this entire space is also going to get competitive on D Street too. How would you look at this?
Yeah, again, I think a pretty long runway for all these players, predominantly led by then when entering into a quick commerce space, where we are seeing that the total addressable market is pretty large for all the players. Obviously, in short term, we have seen increase in competitive intensity by Zepto, which is due for an IPO. But having said that, ultimately, you need to have a long term view in such kind of sector, new age businesses, where there can be a volatility in terms of cash flow. Cash burn can increase at any moment, and at the same time, the company may tweak the strategy to ensure that profitability is a foremost priority for. So I think again, very similar to QSR space, maybe buy on deep or a gradual accumulation is the right strategy. So we feel both Zomato and Swiggy post corrections are trading at a decent valuation, and one can look at both the counters from a medium to long term perspective.
Okay. Let's now focus on the upcoming Q3 earnings and see what do you expect, viewers, in terms of how the companies are likely to post the earnings and what should be your strategy right ahead of that as well. So we have two reports that have come in on the Q3 earnings. We have Motilal Oswal talking about how the Nifty 50 profitability is seen growing by 8% year on year for the Nifty companies. For the revenue front, they see the growth at 11% on a year on year basis, and the earnings momentum they believe will be steady in October to December quarter. Now, what Nuvama has said in the earnings preview report, they believe again the Nifty 50 PAT is growth seen just at 1%. So that's where the differential is. Whereas Motilal Oswal expects an 8% growth there. It's Nuvama that expects just a single 1% growth year on year as far as the Nifty 50 profitability is concerned. Revenue, they again see it at 5%. So lower than what Motilal Oswal has penciled in. The EPS growth they feel could be flat at 5% in first half of FY20, the calendar year. We could also be looking at the risk of FY26-27 earnings downgrades, which are now getting increased. They believe high valuations are warranting defensive bias at this point in time. That's what they've clearly mentioned. Nuvama has listed out some sectors where they believe there could be strong growth vis-a-vis where could be weak growth. So the weak growth sectors, according to Nuvama, could be IT, BFSI, Pharma, FMCG and chemicals, whereas they expect strong growth to be delivered across domestic autos, metals and industrials. They're also believing that internet, telecom, jewelry spaces are likely to see a 15% revenue growth, and this could be 11th straight quarter of single-digit revenue growth for the large part of the universe is what they have mentioned. Now, what we also have is that the key drivers that a lot of brokerage houses are penciling in our rate cuts, the tax relief, the capex push, the budget reforms, and that's likely to improve the sentiments even going forward. So let's try and understand and decode this for you now with Sunny. Sunny, ahead of the earnings, where is your concentrated focus?
I think, no doubt, I think the entire consumption pack is well placed to deliver a healthy earning growth. So whether it is auto ancillary, or for that matter, discretionary pack like jewelry. So we have seen a very robust update, either in provisional business update, which has came in during the last week, and at the same time, auto sales number continue to remain robust. So I think entire consumption pack will deliver a healthy earning growth. When we talk about a December quarter numbers, obviously December quarter is always an seasonally weaker quarter for an IT pack. But having said that, despite of a weaker number, I think the focus will be more on an demand environment from a next 12 month perspective from an IT pack, especially when we have seen a very deep correction in the entire IT pack during the last 12 months. So valuations have turned comfortable. So even a minor positive commentary or minor upgradation in terms of growth guidance can lead to a revival in terms of or upgradation in terms of for that matter for an entire IT pack for next 2 years. Banks, everyone know that NIMs are likely to remain under pressure, although slightly maybe offset by moderation in CRR rate. But having said that, again, the NIMs may bottom out during the quarter four, and in fact, FY27 is a year where we may see an expansion in NIM also. So I think banks and IT, which has got a larger weight, both in terms of profit pool and at the same time in terms of the index weight. So those are the two sectors obviously that will be lagging optically in terms of earning growth. But outlook will, I believe that outlook is likely to be far better when we talk about FY27 and 28 in both these packs. So I think obviously December quarter is a quarter where we may see a high single digit kind of profit growth. But what is important is that market is always forward looking, and any hint towards a double digit earning growth on for an entire consolidated pack of Nifty 50 for 27 and 28, that should be enough to give a lot of optimism in terms of market sentiment going forward.
Okay. In fact, Morgan Stanley, in its India strategy report, has actually voted confidence in the improving earnings growth for domestic companies. They have said that there could be a sharp turn in earnings growth that is expected due to rate cuts, the tax cuts, that's likely to lift the growth cycle. They also believe the post-COVID hawkish macro stance is now unwinding. Capex front loading is supporting the recovery, and GST savings of 1.5 lakh crore rupees is a big positive there. The budget 2026, they believe, may bring in capital market reforms, and that's what they are penciling in. Let's understand that. Sunny, throughout 2025, through various instances, we have seen the government's focus on taxation reforms. Budget 2025 brought in the massive direct tax benefits coming in for a large part of taxpayers. Then when we looked at the Income Tax Act overhaul, that also brought in a lot of industry-related changes. Then we saw GST rationalization in September. Continuing with that taxation reform, do you think in the upcoming budget 2026, it could be the capital markets related taxation reforms that could be on top radar of the government? Will there be some relief on the LTCG, STCG front?
Again, hopeful always feel that government should ensure that at least capital market as a segment should not be looked upon as a key tax driver for an government. In fact, government should encourage a long-term capital investment in a market. So at least on LTCG front, we may expect that the tenure for an to claim an LTCG benefit can be extended from 1 year to 2 years, and to some extent there can be a moderation in the taxation rate also. And at the same time, to attract the foreign investor, the gift city, we may see some update in terms of investment through a gift city. So that can be a positive thing. And one more thing, a double taxation, which has been always been a case, like on buyback or for that matter on the dividend distribution tax. There can be some expectation in terms of reforms over there. Overall, hopeful that yes, capital market as a segment should get some benefit in an upcoming budget. And having said that, I think just to boost an economy, obviously, as discussed earlier, I think capex-driven budget, and at the same time, so as you rightly pointed out, the income tax as well as GST indirect taxes has been taken care of. Maybe in an upcoming budget, custom duty is the one segment where I was reading in some media article also that can be one of a focus area where inverted duty structure can be taken care in an upcoming budget so as to ensure that domestic producer or service provider are very competitive in terms of exports, so that in a current uncertain export environment, Indian companies can compete with an global players to gain the business and diversify the export basket only apart from US to various other countries.
Okay, fair point. So that's as far as the earnings expectations go, viewers. And now let's come to the markets currently. We are seeing some more pain in the markets. now about 100 points lower on the Nifty. We are inching closer to the 26,000 mark. 26,035 is where we are at. We've already slipped to the low point of the day, 0.4% now lower. Just within the first hour and 10 minutes of trade, we have actually drifted lower. All the sectors are down in trade. It is the India VIX that's in the green right now. That's indicating heightened volatility concerns now at 10 odd levels, 1.6% higher. On the Nifty, you just have about 10 to 12 stocks that are still hovering up, including Eternal, Adani Ports, BEL, Bajaj Auto, Indigo, Bajaj Finance and Titan that continues its positive mood. But a large part of even the broader market stocks have drifted lower. Sunny, what do you think is the key pressure point here in the markets? And do you think it will be just the pre-budget news flows and the earnings news flows that will have in it to pick up some of the trends from here? Otherwise, it's all the global related news coverage that's leading to these losses?
Yeah, obviously, I think a lot of rumors are floating that during the next few days there may be an attack on Iran by US and Israel, and that is one of the key headwinds as far as markets are concerned. But having said that, as the earnings season kickstart from a 12th of Jan, we may see a stock specific reaction which can pan out in the market, and obviously budget is one of an key event to look forward to for a market. I think, as discussed earlier, I think Indian macros, Indian earning scenario or valuations are very well placed. I think global uncertainty is something which is keeping a lead on the market rally. So once that fades away, we may see a healthy up move in the market over the period of next 2-3 months.
Okay, got that. All right, Sunny, thank you so much then for being with us on this very program and helping us with all your insights on the markets and the various themes that we've discussed. Good to have you with us. Stay tuned with us, viewers, as a lot more coming up on your screens. And of course, I'll be back for the 12 o'clock show, which brings you the daily calls, a show that focuses on taking your queries and answering them from top market experts. Stay tuned for that as well.